As the global economy teeters on the edge of collapse, we find ourselves engulfed in a whirlwind of conflicts led by reckless decision-makers. Central banks, armed with flawed strategies, proclaim that inflation is under control, that economic growth is just around the corner. But this is nothing less than a fundamental lie. They assure the public that they have tamed the beast of inflation, only to ignore the rising tides of devastation caused by their own policies. Their reassurances serve as a thin veil, masking the reality we are starting to face. An economic environment marred by volatility, uncertainty, and impending crises. While the Federal Reserve broadcasts optimistic projections about monetary easing and stimulus measures, we have to confront a harsher truth lurking beneath the surface. Companies across the spectrum are facing unprecedented challenges. Layoffs are becoming commonplace as enterprises struggle to navigate the treacherous waters of rising costs and dwindling consumer demand. The reality, as we see time and time again, is that what policymakers articulate is often detached from the brutal facts experienced by everyday citizens. In this context, we cannot overlook the silent signals being sent by the ultimate insider. Warren Buffett, an investor with a track record that spans decades and an acute understanding of systemic risk, has remarkably shifted his stance. He isn't merely reacting, he is proactively hoarding cash. While others chase speculative bubbles, Buffett's decisions reveal a profound understanding of the storm brewing on the horizon. His actions tell a story, a tale of caution amidst the cacophony of optimism promulgated by those who claim to have things under control. As the public sips the Kool-Aid being served by the media and government authorities, Buffett's behavior suggests a counter-movement. He has cut back on investments in fragile sectors, divesting from consumer goods and banks that appeared viable, but could soon be unmasked as house of cards. Why hold on to stocks that may lose their value amidst systemic upheaval? Why gamble in a market driven by speculation when one can play the fool and safeguard their capital for what is coming next? This quiet accumulation of cash is not just a personal investment strategy. It is a clarion call regarding a troubling future, the warning of an impending disruption that the average investor might overlook in their pursuit of instant returns. This behavior speaks volumes in stark contrast to the reassuring words of regulators and policymakers. When faced with uncertainty, the astute investor opts for liquidity, strengthening their position to weather the storm. Buffett's withdrawal from the frenzy reflects an understanding that the market operates on the precipice of a deeper crisis, fundamentally different from short-term fluctuations. Moreover, as the government prepares for well-meaning yet misguided initiatives to stimulate economic growth, one must ask, at what cost? Their proposals for ever more expansive fiscal policies and inflated regulations do not unwind the existing threats. Rather, they usher in uncertainty, leading individuals to potentially lose everything they hold dear. When central banks argue that they have the tools to combat emerging issues with finesse, the truth is, they remain stuck in a perpetual loop of increasing debt and flawed capital allocation. The so-called solutions they offer are simply band-aids on open wounds. The alarming signal from Buffett is loud and clear. Navigate this storm with caution. Those who fail to heed this wisdom risk losing everything. The rules of the game are changing, and if we continue to cling to the notions fed to us by authorities, we may soon wake up to a reality where we own nothing while our investments vanish into thin air. As we stand at this precipice, it's vital to recognize the gravity of the decisions that lie ahead. The market may be unable to weather the regulatory storm without dire consequences. It is essential to remain vigilant, perpetually challenging the established beliefs that have led us to this critical moment. Warren Buffett's strategic inaction serves as our harbinger, an indicator that the time has come to approach one's financial legacy with the seriousness it warrants. The silent signal is there for those willing to listen. The fate that awaits is not just a concept. It is quickly becoming the new reality. Imagine a bustling marketplace, vibrant with energy and exchange. Stalls brim with goods, colorful fruits hang from awnings, and chatter fills the air as eager buyers mill about, examining wares, haggling over prices, and ultimately making purchases. This marketplace represents our financial system, where every individual participates in what they believe is a fair exchange. However, beneath this cheerful surface lurks a sinister reality, an unseen hand that not only influences prices, but also has the power to seize your very possessions. Let us simplify this complex web of finance with a brutally simple analogy: the community bank. Picture yourself as a loyal customer depositing your hard-earned money into this bank, confident that it will be safeguarded for your future use. You come to trust this institution, believing that your deposits empower you to fulfill dreams, purchase homes, send children to school, and plan for retirement. You see, in this arrangement, you are not just a customer, you are a stakeholder in the community's prosperity. But here lies the fundamental flaw. As you deposit your cash, the bank engages in a risky game, leveraging your funds to invest in precarious schemes, essentially gambling with what you thought was safe. Rather than holding your money as a guardian, the bank transforms into a player on a casino floor, often forgetting its role and duties. When the banks take these risks and the inevitable downturn arrives, they attempt to shore up their losses, not by protecting their customers, but by reallocation, redirecting funds, or worse, declaring insolvency. In these moments, the community bank's initial promise devolves into a nightmare, where customers are left scrambling, only to discover that the money they believe to be theirs has been mismanaged to the brink of extinction. Now, this situation parallels the broader financial landscape with striking clarity. Governments and central banks, much like the community bank, have engaged in reckless behavior, validating their actions through a litany of benign-sounding regulations and policies. They claim to usher in stability through quantitative easing or fiscal stimulus, yet these measures are merely smoke and mirrors. Each decision churns out more debt, reinflating a bubble built on quicksand. Their assurances that inflation is under control or that the economy is on an upswing resemble the comforting whispers of the bank manager promising that everything is fine, right before declaring bankruptcy. The old system has broken down. Like a once thriving marketplace overtaken by a storm, the essential functions of trust and stability are being dismantled. Regulations meant to safeguard your investments are twisted into loopholes, rendering your assets susceptible to confiscation. The laws of 2026 may implement draconian measures that redefine your ownership, enforcing asset freezes tantamount to ownership without control, a scenario where you own nothing, but the government still has the ability to exercise authority over your wealth. Your stocks, once considered a ticket to financial freedom, increasingly resemble mere tokens within a rigged game. Consider the world of investment stocks, likened to shares of produce in our marketplace analogy. You may believe that purchasing a slice of a company grants you rights, much like owning a portion of the market stall allows you to reap the benefits from sales. However, if the stall owner falsifies their earnings, or if the government steps in to mandate price ceilings, your stake diminishes to nothing in the blink of an eye. Unsuspecting investors soon find they have no true claim to the assets they purchased. They are subject to the decisions of a higher authority that wields excessive power masked by veils of regulatory jargon. In recognizing this truth, we find ourselves in a precarious position. Just as the community bank neglected its obligations, investors are left at the mercy of an unyielding system. The age of naive trust in the status quo has passed. Those who cling to the false promises of regulators, believing their investments will stand the test of time, risk losing everything. The silent warning from Buffett echoes louder than words. Consider your role in this marketplace and the consequences of inaction. Do not allow yourself to be swept up in the optimism perpetuated by those who stand to benefit while you suffer. The time for understanding the mechanisms at play is now, lest you find yourself navigating a landscape where you truly own nothing amidst chaotic regulations and financial upheavals. Imagine it is Tuesday morning. The faint glow of your smartphone rouses you from sleep, revealing notifications that have piled up overnight. You sit up, rub your eyes, and brace yourself for another day of navigating the complexities of a world that seems increasingly hostile. As you reach for your coffee, the thought gently flickers in your mind. Will today be the day everything changes? You walk to the kitchen, muttering about the rising costs of basic groceries, a relentless reminder of inflation gnawing at your purchasing power. Flipping through the news, headlines flash about the government's latest initiatives aimed at rejuvenating the economy. They proclaim increased funding for essential services and promises to stabilize the markets. Yet beneath the surface, you sense something deep and unsettling, a gnawing worry that echoes the alerts you had dismissed in the past. You decide to go through your most recent transactions. Your bank account reflects enough to weather a storm, or so you thought. Suddenly, a notification blinks ominously on your phone. Transaction declined. panic spikes your heart rate as you attempt to purchase that gadget you've spent weeks eyeing. The details are unclear, too many transactions, insufficient funds, but intuitively you feel it's more than just an ordinary banking glitch. What if this decline isn't about your finances, but part of a systemic shift in control? You toss your phone aside, frustration boiling over. You glance towards the front door, double-checking your work attire. The oppressive feeling of uncertainty wraps around you tighter with every passing moment. You've heard stories of friends laid off without warning, of companies cutting corners as they brace for a recession. You recall the countless conversations in the break room, trading fears of an economic downturn while pretending everything is normal. Today, you remind yourself, it feels less like a conversation and more like a prophecy. Fast forward to the afternoon, and you arrive at the office. The atmosphere is unusually somber. People are whispering in hushed tones, glancing nervously at the HR department's door. Suddenly, an email arrives. Your stomach drops as you read the message. Layoffs are imminent. The decision isn't personal. It's a brutal reality dictated by an unstable financial landscape that you had hoped would spare your job. The same leaders whose words now echo refrain, "We have it under control," are the very ones who wield their authority like a sword, severing job security without hesitation. As you process the gravity of your situation, it sinks in. The company's stock that you had watched over the years, almost like a beloved pet, has dwindled in value, trapped under the weight of government regulation and inflation. What once felt like an investment in your future now appears vulnerable, a pawn in a game played by those who view your existence as merely a number on a ledger. By the time you step outside to the parking lot, the sun is setting, but it does little to lighten the mood. The world around you seems surreal, a backdrop to an unfolding nightmare. Cars line the streets, but every vehicle represents someone like you, grappling with uncertainty. You think of your investments, stocks purchased with the hope of building a nest egg, now caught in a web of obfuscation. Your heart aches, realizing that you may soon face a far graver consequence. The power to confiscate your holdings has now seeped into the hands of those who do not have your best interests at heart. Your mind races with scenarios of a reality where the laws of 2026 turn your investments into mere illusions. What will happen to your assets when the hands of the government grasp tighter around the very fabric of ownership? The idea that you could lose everything you have worked tirelessly to build with little recourse sends a chill down your spine. Amidst your swirling thoughts, the reality that emerges is inescapable. The systems we once trusted stand poised to claim not just your investments, but your very autonomy. You cannot turn a blind eye to the true dangers lurking in the shadows, hidden behind an illusion of stability. If you are enjoying topics like this and want to stay informed about the real risks, consider following our channel. Knowledge is your best defense against the brewing storm. Informed and prepared, you may just steer clear of the repercussions that come from blind trust and naive compliance. History serves as an unwavering compass, guiding us through the treacherous waters of financial and economic crises. In the annals of time, we have borne witness to epochs of turmoil and betrayal, where the words of politicians and central bankers belied the stark realities faced by the populace. As we grapple with the specter of confiscation looming on the horizon, we must take heed of the lessons imparted by our predecessors. Consider the great stock market crash of 1929, often cited as the harbinger of the Great Depression. In the years leading to this catastrophic event, a wave of optimism fueled rampant speculation. Individual investors flocked to the markets with blind confidence, seduced by the allure of quick riches. Yet, when the facade collapsed, it was not just wealth that vanished. Lives were upended, and futures were decimated. The government, tasked with oversight and protection, faltered. Instead of providing the necessary support, they shifted to draconian measures that led to further economic deterioration, revealing that the very institutions designed to safeguard prosperity lacked competence or morality when faced with crisis. Fast forward to 1937, a year that revealed the fallacy of premature optimism in an economic recovery. Despite the ballyhoo of economic growth, the Federal Reserve, in its infinite wisdom, tightened monetary policy, assuming the worst was behind them. A second downturn ensued, leading to a further reduction in consumer confidence, layoffs, and a renewed spiral into recession. It starkly illustrated how easily the hands of those in power could reverse the fortunes of the many, demonstrating that the lessons from 1929 remained unlearned. In 1970, the situation repeated itself, as the twin forces of inflation and unemployment forged a new term in economic parlance: stagflation. Policymakers, unable to reconcile the delicate balance between controlling inflation and fostering job growth, chose to tread water. Consequently, the average American lost faith in the institutions meant to support them. Instead, what ensued was a decade characterized by rising prices, stagnant wages, and mounting disillusionment, a palpable reminder that inaction often begets dire consequences. Fast forward to 2013, a time marked by the collapse of the financial system in Cyprus. In a twist that would send shockwaves through the banking world, depositors woke to find their savings seized as a part of a bailout agreement. The government, under the guise of economic necessity, confiscated a portion of private bank accounts without warning, shattering the illusion of financial security for the citizens who had dutifully entrusted their savings to banks. This unprecedented action revealed not only the fragile nature of public trust, but cast a dark shadow over the integrity of individual ownership. Cyprus stands as a solemn warning. One can wake up to a reality where personal assets become bargaining chips in a desperate game played by those in power. What do these historical precedents tell us? Each unfolding crisis exposes the deceptive nature underpinning promises of financial security, or rather, the myth of such security in a world governed by those who claim to know better. Time and again, we have witnessed the devastating impact of misplaced trust in governments and financial institutions that prioritize their interests above all else. The rhetoric of economic recovery, often heralded with much fanfare, serves as a thin veneer cloaking systemic issues festering below the surface. We now stand on the threshold of an entirely new chapter. The seeds of unrest are watered by the echoes of history. This time is not different. We are merely the latest actors on a stage set by those who came before us. The narratives of 1929, 1937, 1970, and 2013 remind us that to forget our history is to court our own demise. As we grapple with financial ownership and the specter of confiscation, we must recognize the delicate balance between trust and vigilance. In a world where government overreach can reframe ownership itself, it is vital to tread with urgency and caution. The lessons etched into our past must embolden us to question the assurances of those in power. Adopting a stance of prudent skepticism will serve as our most potent shield against the encroaching tide of confiscation. It is imperative that we heed the echoes of history, for therein lies the blueprint of our future. The warning is clear: prepare and remain vigilant, for the consequences of inaction may render your hard-earned assets little more than a mirage within a systematically flawed construct. As we unpack the narratives shaping our financial realities, one striking truth emerges: what you are being told is not the whole story. The crux of the issue is not merely inflation, although it poses a significant threat. The true hidden crisis lies deeper within the veins of the financial system, a crisis rooted in the very architecture of our economic structure and legislative frameworks. It is here, in the shadowy halls of government, that obscure legislation is crafted, laying the groundwork for scenarios that could fundamentally redefine ownership. Consider the rise of central bank digital currencies, or CBDCs. On the surface, these digital currencies may appear as a helpful evolution of our financial system, a modern solution designed to streamline transactions and enhance efficiency. However, those in governance are acutely aware of the power that accompanies such an overhaul. The reality is that CBDCs could serve a dual purpose: to facilitate transactions, and more insidiously, to impose greater control over individuals' finances. Gone are the days of anonymous transactions and decentralized currency. A CBDC represents a centralization of monetary authority, providing governments with the ability to monitor every transaction down to the smallest detail. Imagine a world where every dollar you earn, every purchase you make is traceable and scrutinized by the state. In this environment, the narrative would shift from encouraging financial independence to enforcing compliance. Thus, what appears to be a mere technological upgrade could lead to actual confiscation of wealth under the pretext of social stability or economic security. Your own currency, which you would think grants you purchasing power, could easily be weaponized against you, supporting not your financial autonomy, but a system where your every action is documented and potentially restrained. Take a step further and envision the implementation of capital controls. a mechanism that restricts the flow of money across borders. Meant to safeguard the integrity of a nation's economy, capital controls are arguably more insidious than altruistic. History has shown that these measures often serve to protect the interests of those in power, while the populace suffers the consequences. As the economic turmoil continues to mount, governments may resort to implementing draconian capital controls that could limit your ability to withdraw money, transfer wealth, or even invest in opportunities outside the reach of the state. The justification? National security, social unrest, or economic stability. The rationale may change, but the outcome remains the same: diminished personal freedom and control over your assets. Furthermore, layers of regulation increasingly suffocate the markets, distorting the principles of true ownership. With new laws and policies, authorities can intervene in personal investments, devaluing assets through taxes, fees, and levies that emerge seemingly overnight. The underbelly of this regulatory expansion lies in a shifting paradigm, where what once constituted personal wealth is now deemed a collective resource, thereby legitimizing state intervention. The paradigm shift does not stop at taxes. It extends to the very core of asset ownership, where individuals find themselves unable to freely access or utilize what they thought was theirs. The media scarcely scratches the surface of these looming threats. Instead, they focus on the surface-level data, trendy inflation rates and employment figures that distract us from the profound implications that arise when ownership itself is contested by those who profess to know what's best for the economy. The interpretation of conditions varies, but the underlying reality resonates loudly. The individuals and entities in power are concocting a cocktail of legislation that safeguards their interests while dismantling the financial sovereignty of the average citizen. What we face is not simply an evolving economic climate, but an omnipresent sense of threat rooted in governmental overreach. Each of these solutions reflects a persistent reliance on eroding the rights that empower individuals to own and control their wealth. This slow encroachment is destined to worsen systemic imbalances, cultivating an environment where the average person bears the brunt of decisions made behind closed doors. As history has taught us time and time again, inaction and complacency lead to disadvantageous outcomes. The warning signs are clear. The mechanisms to siphon wealth are already in play, cloaked in the guise of progress. The silent whisper from the depths of the market grows ever louder. If you fail to recognize these hidden crises, you risk finding yourself stripped of agency, standing amidst a disillusioned populace betrayed by the very institutions designed to protect them. As you contemplate your financial future, bear witness to the unfolding narrative, a story that echoes the tragedies of the past. Do not underestimate what lurks beneath the visible mechanisms of the current financial environment. The hidden crisis is here, and although the storm rages on, those who remain vigilant, those who recognize the subtleties of the impending changes, will be the ones able to weather it. Prepare yourself, for the tide is turning. Warren Buffett's investment philosophy is deeply rooted in a straightforward principle: invest in what you understand, and avoid the herds that chase speculative trends. Recent developments in his portfolio choices elucidate this principle with remarkable clarity, particularly in a climate defined by uncertainty and risk. The pivot in Buffett's strategy reflects a sobering acceptance of the fragility that pervades traditional banking and consumer goods sectors. Such a pivot invites a close examination of the assets he is selling versus those he is buying, revealing the strategic underpinning behind these decisions. First and foremost, let's analyze what Buffett has been offloading. His recent sales primarily involve sectors considered fragile, most notably banks and consumer goods manufacturers. The rationale is painfully clear. Banks have been notoriously vulnerable in times of economic strife. The regulatory landscape is shifting, and as we have observed, banks are increasingly entangled in webs of their own making. They are held accountable by new legislation, which the average investor is woefully unaware of. Legislation that threatens the very liquidity of institutions that are supposed to safeguard our capital. Banks may show surface-level stability, but the underlying risks exposed by rising interest rates and an unpredictable market render them perilously fragile. Consumer goods have similarly fallen out of favor for Buffett. These businesses often operate on thin margins and are more susceptible to economic downturns. With rising inflation and increasing input costs, the ability to pass these expenses on to consumers is greatly diminished. Companies that once seemed solid now resemble houses of cards, set to topple under the weight of economic instability. Buffett's divestments in these sectors exemplify his recognition that such investments, once perceived as safe havens, are now fraught with peril. In stark contrast, let us consider what Buffett is actively acquiring. His recent movements exhibit a clear preference for real assets, investments in sectors such as energy, railroads, and short-term treasury bills. The shift towards these asset classes serves a dual purpose, providing both stability and a hedge against inflation. Investing in energy resources, for instance, positions Buffett to capitalize on the enduring demand for oil, gas, and renewables while mitigating exposure to volatile market swings. Railroads, the lifeblood of transportation and logistics, fortify his portfolio against the growing inefficiencies in supply chains, ensuring he holds tangible assets rooted in the realities of commerce. Additionally, the increased allocation to short-term treasury bills demonstrates an acute awareness of the current economic landscape. In a world where central banks are mired in indecision and adopting dubious policies, short-term bonds offer a safe harbor for liquidity. They provide a strategic buffer, allowing quick maneuverability, maintaining access to capital while minimizing risk exposure. This allocation reflects a disciplined approach focused on survival rather than the reckless speculation that characterizes current market behavior. The overarching strategy reflected in Buffett's recent actions can be distilled into the dichotomy of survival versus speculation. While many investors are drawn to the siren song of quick gains, chasing after the latest inflated technology stock or the fleeting promise of crypto fortune, Buffett stands firm. He understands the impermanence of such pursuits. His investment path is guided by an unwavering focus on long-term viability, appreciating that wealth built on speculation is built on shaky ground. Buffett's current strategy is a stark warning to those caught in the throes of modern-day investment euphoria. The lesson is clear. While others are engrossed in a risk-laden chase, the path to enduring wealth lies not in the ephemeral trends that captivate the masses, but in the steadfast embrace of fundamentals. The contrast in Buffett's actions serves to illuminate the importance of discernment in investment decisions amidst turbulent economic realities. To embody the wisdom of Warren Buffett is to reject the allure of the moment, to comprehend the weight of history, and to act decisively in accordance with that understanding. As the world edges toward legislation threatening personal ownership of investments, the insight gained from Buffett's current portfolio moves casts a vital light on the actions we must take, or risk the consequences of inaction. In this age of uncertainty, clarity emerges not from speculation, but through investing in the very foundations of our economy. It is time to follow suit, for the storm is gathering, and survival demands preparation. As we navigate through the uncertainty that looms over our financial future, it is imperative that you take action now to safeguard your wealth and autonomy. In light of the potential for draconian measures that could redefine ownership, consider the following steps as your survival guide. These are not mere suggestions. They are necessary actions to fortify your financial position and begin reclaiming control over your destiny. First, conduct a thorough audit of your portfolio. This is not just about examining what you hold, but understanding the inherent risks. Identify what assets are susceptible to the shifting regulatory landscape. If your investments exist in fragile sectors, such as consumer goods or banks, it is time to reconsider your holdings. You must assess whether your stocks are merely tokens in a game dictated by those above you. If they are, sell them. Convert those investments into cash or liquid assets that are not subject to government manipulation. The point is not just to seek short-term gain, but to protect what you have worked so hard to build. Hold on to stocks and sectors that offer concrete value in an uncertain economy, but do not hesitate to divest if these holdings expose you to unwarranted risks. Second, it is critical to bolster your liquidity. Accumulate cash reserves or invest in money market accounts that provide immediate access to your funds. This strategic decision empowers you to navigate unforeseen obstacles, whether they be economic downturns or sudden regulations that could limit your access to your own wealth. Consider short-term treasury bills that offer stability while allowing you to maintain liquidity. Ultimately, the goal here is to ensure you have immediate access to capital in times of crisis, a buffer against the inevitable storms that lie ahead. Third, consider the merits of self-custody. In an age where digital currencies and centralized banking systems gain traction, it is sound policy to take charge of your own wealth. If you hold any digital assets, explore hardware wallets or decentralized finance options. Owning and managing your private keys ensures that you, not an unseen entity, hold the authority over your assets. The consolidation of power within financial institutions risks your personal autonomy. By adopting self-custody, you reclaim it. This does not mean you must abandon all traditional banking. Rather, you need to become more prudent in how you engage with the system that seeks to exert control over your financial freedom. Fourth, reevaluate your real assets. Identify tangible investments that can withstand times of volatility. This includes real estate, precious metals, or commodities that hold intrinsic value. These real assets serve as hedges against rising inflation and the creeping potential of government overreach. Investing in physical commodities not only diversifies your portfolio, but insulates you from the capricious nature of digital assets during crises. The solidity of tangible investments grants you a root within the financial landscape that cannot be easily severed by arbitrary legislative changes. Finally, prioritize debt reduction. In uncertain times, debt can become a chain that hinders your financial mobility. If you carry high-interest debt, make it your mission to pay it down as swiftly as possible. The less debt you hold, the more freedom you confer upon yourself to act, invest, and navigate the financial landscape without being beholden to creditors. Consider leveraging any available assets or cash reserves to eliminate these obligations. Resilience springs from the capacity to pivot without encumberment. Thus, reducing debt is tantamount to fortifying your financial autonomy. As we march forward into the complex financial landscape of the future, arm yourself with knowledge and action. The seconds spent in contemplation are best served by proactive measures. Understanding your holdings, enforcing liquidity, embracing self-custody, investing in real assets, and eliminating debt are not just steps. They are your lifeline. In an unpredictable world where you may one day own nothing if you heed the warnings of obfuscating authorities, it is up to you to reclaim your assets and ensure you are prepared for whatever arises. The time for action is now. As we conclude this examination, it is essential to consider the profound implications of what we have discussed, the ramifications of complacency in the face of a rapidly changing financial landscape. The proverbial writing is on the wall, and it is inscribed in stark letters that mock our naive trust in the system. We are at a crossroads that will define the fate of our financial autonomy and wealth. The unsettling truth is that our financial institutions and governing bodies, entrusted with the stewardship of our prosperity, may very well impose policies that redefine ownership itself. The inevitability of systemic correction looms larger with each passing moment. History has shown us time and again that when the foundations of an economy are built on quicksand, the collapse is not a matter of if, but when. The catalysts that propel these shifts are already in motion, driven by those who fail to grasp the perils associated with their every decision. The correction will arrive, and when it does, we must confront the stark reality. Those who have failed to prepare will discover the harshness of this new existence. A world where you own nothing, and the authority seizes the narrative. This is not merely a warning. It is a calling, a clarion call to self-responsibility. No one is coming to save you. This reality is painful to accept, yet it is a truth that will empower you to take control of your destiny. The notion that government intervention will shield you from loss, that regulators will sidestep your plight, is a myth that history has all but dismantled. The complexities of human governance often lead to unwavering incompetence or, worse, malevolence, wielded by those who would prioritize power over the welfare of the citizen. Those who turn a blind eye to the shifting tide are willingly complicit in their own downfall. The future will be governed not by the fiery rhetoric of opportunistic leaders, but by the cold, calculating forces that dictate the economy's rhythms. Those who possess foresight and courage will navigate the storm's treacherous waters, while the complacent will be swept under the tide, trapped in an overwhelming current of disbelief and betrayal. This moment demands vigilance. It demands a recalibration of what security means in an economic structure that is, at best, volatile, and at worst, predatory. Consider the array of moves you must undertake. You should not merely react to the forces around you, but take a proactive stance against them. Equip yourself with knowledge, shield your wealth with prudence, and invest not only in assets but in the understanding of the financial ecosystem that governs your fate. The looming legislation of 2026 is not a distant specter. It is a palpable threat positioned at the door of our financial stability. Therefore, your focus must shift to actionable strategies that ensure you are not merely swept along by the currents of fate. Analyze your portfolio, bolster your liquidity, engage in self-custody, prioritize real assets, and reduce debt. If your efforts wane in the face of bureaucracy and systemic upheaval, do not expect a safety net to catch you when you fall. As the system corrects itself, and make no mistake, it will correct, ask yourself, will you stand prepared, or will you find yourself among the legion of those lamenting lost opportunities? This path is one that can and must lead you to resilience. Prepare with a stoic heart and an informed mind, for the dawning reality is both a harbinger and an opportunity. Rise to meet it with resolve and determination. Tilting to the winds of change without preparation is a folly visited upon many. You have been urged to heed the lesson of history, a lesson that carries significant weight. Now the responsibility is upon you. Understand, adapt, and act. Your destiny is tethered not to the whims of policymakers, but to your own actions and decisions. There lies a quiet strength in recognizing these truths, a strength capable of guiding you through uncharted waters. Remember, no one is coming to save you. The time to act is now. Prepare yourself for a storm brews, and only those equipped will withstand its wrath. The choice is yours. Act wisely. Fade to black.